Hey, welcome to the What the Wealthy Do podcast, where we break down the money moves that the wealthy make and show you how you can apply those same strategies on your own personal wealth building journey. I am your host, Stephanie Dorsey, the CEO and co-founder of Margins Capital. Margins Capital is an investment firm that is focused on providing women and people of color access to an institutional quality portfolio of alternative assets. All right, so today we're kicking off our multi-part series. I ain't figured out how many parts it is yet. On something that is really a very essential thing that we need to know about, that many of us don't know about, and our eyes start to glaze over. That's why I haven't said what it is yet. But it is so important for us to understand how this works, especially as we are living in this time where interest rates are going up, where you're having different geopolitical risks, as well as inflation and things like that. So what are we going to talk about? Bonds, y'all. I know. Don't, come on now. Go, hang with me, because bonds are a wonderful 8-ball for what's happening in the markets. Bonds are where quote unquote smart money live. So if we can understand what's happening in the bond market, then we can also use that information to determine how we invest in the stock market, where they actually call retail investors dumb money. Dumb, girl. They called you dumb. They ain't called me dumb. Well, maybe they did call me dumb, but whatever. So we are going to learn the basics, just the essentials, the basics of bonds. And I ain't gonna hold you. When I was in business school, my eyes would glass over. Like, I don't even remember learning about bonds. Well, no, I blocked it out. It's like a trauma response. They talked about yield curves and all that. I blocked it out. But hopefully I have made it as entertaining, but also it's simple for you to understand. And so that's what we're going to talk about today. So, okay, I know that bonds don't have the sex appeal that the stock market has. Like, ain't nobody talking about it. Ain't nobody making TikToks about bonds. Ain't nobody talking about these treasuries are going to the moon, rocket ship. Ain't nobody talking about that. I get it. But the bond market is actually like 2 to 3 times bigger than the stock market. It's much bigger than the stock market. Forgive me for not looking up the number. It's literally the foundation of the global financial system. And if you don't understand bonds, you really don't understand how money works, right? And so the wealthy, they never ignore bonds. They don't. And they use them to preserve capital, generate predictable outcome, and balance risk in their portfolios. So bonds are the quiet, stable foundation that allows investors to take bigger risks everywhere else. And so let's get into it. Today, we're just going to do an overview. It's going to be cute. It's going to be sweet. It ain't going to be crazy. We're just going to do an overview, and then we'll start to build on it in the following weeks, where we talk about interest rates and geopolitics and how you should be thinking about including bonds in your investment portfolio. But before we get into it, y'all already know this podcast provides financial education, not financial advice. So let's go. So here are the basics. First, what is a bond? A bond is basically just an IOU. It's a loan. But instead of you borrowing money from the bank, you're the bank. You're lending money to a government or a corporation. And so think about it. When you buy a bond, you're lending money to the bond issuer, the government or the company, and they promise to pay you back at a specific date in the future. And that's referred to as the maturity date. And they pay you interest along the way. Usually every 6 months, you get an interest payment or a coupon payment. And at maturity, you get your entire principal back, which is the original amount you lent. It's basically a CD. It's literally a CD. But for a company, instead of going to get a CD from your bank, right? It's a CD, right? So think about this. When a corporation or a government issues a bond, it's a loan issued at a specific point in time for a specific amount for a specific duration. So think about it. So if Apple, they need to raise $1 billion, they want to build a new factory in China. We know it's going to be in China. We already know it is not going to be in Des Moines, but whatever. So they announced a bond offering. The issue date is May 20th, 2026. It's for $1 billion. The denominations that you can buy is the $1,000 or $10,000 per bond. The maturity is 5 years, so you can get paid back May 20th, 2031. And the coupon rate is 5% annually, to be paid semi-annually, so every 6 months. Say you buy a bond for $10,000, every 6 months, Apple is going to pay you $250 or 2.5% times $10,000 in interest, or $500 or 5% in interest. And on May 20th, 2031, you get your $10,000 back, but you will have earned $2,500 interest over the course of that 5-year time. So Apple gets the money to buy their factory. You get predictable income over 5 years, and plus your money back at the end, right? So that's it. That's a bond. You lent money, they paid you interest. It's all good. You got your money back. Everyone's happy, right? See, it's simple. Simple. All right, but here's where it gets interesting. And this is why the wealthy care so much about bonds, right? So actually, before we do that, I'm going to give you a brief history. Like, bonds have been around forever, for centuries, right? And so governments and corporations have used them to raise money for big projects without having to raise taxes or sell equity, right? Because they don't want to give you a part of their business. They'll just go ahead and raise a bond. So government issues bonds to fund wars. Historically, they did both world wars and also infrastructure to build roads and bridges and schools, to cover budget deficits when the spending exceeds tax revenue. You know, America know a little something about that. And then corporations issue bonds to fund expansion, building new factories, launching new products, acquiring businesses, as well as just to cover any cash flow gaps that they might have in their operations. So obviously the bond issuers, governments, and corporations like them because it's cheaper to offer bonds as opposed to offering equity or something else. And then bond purchasers or investors like it because we get predictable cash flow. And so we like that. All right, let's talk about some of the vocabulary. And we've already talked about some of it, but face value or par value, that's the amount that the bond will be worth at maturity. So it's usually $1,000 or $10,000. So a bond with a face value of $10,000 will pay you $10,000 when it matures. We talked about coupon rate already. That's the interest that the bond is going to pay you. We talked about maturity date. That is the date when the bond expires. So in the Apple example, that was 5 years. The maturity date was May 20th, 2031. But there are different types of bonds. There can be short-term bonds, 1 to 3 years, intermediate term bonds, 3 to 10 years, or long-term bonds that will last from 10 to 30 years. Yield is the return you actually earn on the bond, which can be different from the coupon rate depending on what you paid for the bond, right? So we'll dive deeper into yield. But here's the basics. If you buy a bond for less than the face value, right? So the face value of the Apple was $10,000, but say we bought it on the secondaries market for $7,000, then your yield is higher than the coupon rate, right? Because at the end, even though you bought it for $7,000 and in 2031, you're going to get $10,000 back. So we like that. But if you buy a bond for more than the face value, your yield is lower than the coupon rate. So yield and coupon rate are not the same. That's the point. Credit rating. And this tells you how likely the issuer is to pay you back, right? So rating agencies like Moody's and S&P and Fitch, they grade bonds. And so you have AAA bonds, and these are the safest, like U.S. Treasury bonds are considered AAA, very big top corporations like Apple. Then you have triple B or BAA or higher. These are investment grade. They're safe, but they're slightly riskier. You have BB or BA or lower. These are your junk bonds or high yield bonds. They are risky. They have higher interest rates. So the more risky the bond, the higher the interest or coupon rate. So the higher they're going to pay you, but the greater chance for a default, right? So let's talk about default risk. This is the risk that the issuer can't pay you back. And so U.S. Treasury bonds have virtually zero default risk because, you know, the government literally can just print the money and they'll just pay you back with the printed money that they print. I mean, it is what it is. Corporate bonds have a higher default risk because companies can go bankrupt. That's why corporate bonds pay higher interest than government bonds. Like, trust me, they were holding bonds for the Lehman Brothers in 2008. They were holding bonds for Enron. So it is a thing. So there are two ways to own bonds. You can buy individual bonds. You buy a specific bond directly, like a U.S. Treasury or a corporate bond, or you can invest in a bond fund or a bond ETF or index fund. So like if you go on Vanguard or Charles Schwab, like you should know what you want and be intentional. Okay. There are different types of bonds. Like all bonds are not the same. So let's break down the categories. So we talked about treasury bonds. So these are U.S. government bonds. They're issued by the U.S. Department of Treasury. We already talked about the default risk in there. They're supposedly virtually risk-free. But you have T-bills that mature in less than a year. They don't have coupon payments. They are sold at a discount. You have treasury notes, which mature in 2 to 10 years. They pay interest every 6 months. And then you have treasury bonds, which mature in 20 to 30 years, and they pay interest every 6 months. And so you also have treasury inflation protected securities, and these are TIPS. The principal adjusts with inflation, so it protects against rising prices. As you can imagine, that's a good thing. All of these, the wealthy love these because they're backed by the U.S. government and they offer predictable income. The second type of bond family are municipal bonds. And so these are bonds that are offered by smaller government, state and city and local government agencies. They're issued by state and local governments to fund public projects like schools, highways, and water systems. The wealthy love these because they provide tax-free interest, right? So you don't pay federal taxes, and often the issuing state doesn't charge you taxes on the interest that you receive for them. And so they're really great for high earners and high tax brackets. Right? So like if you're in the 37% federal tax bracket and you buy a municipal bond paying 3% tax free, that's the equivalent to a taxable bond paying about 4.76% interest, right? So the math works out because you're getting it tax free. So you're not having to pay any tax on the returns that you receive. So yay. All right. The other type of bond that you should be aware of are corporate bonds. So then corporate bonds are separated into investment grade bonds that are issued by stable corporations like Apple. These bonds are going to be lower risk, but they're also going to have lower yield. And then you have high yield, and they're referred to as junk bonds. So these high yield bonds are issued by riskier companies that have higher yields, but you have the risk of the company not paying you back because they go under or something like that. Not because they're sketchy, even though you can find a sketchy junk bond. So, I would imagine, I'm gonna go out on a limb and say that the people who are listening to my podcast, y'all are not about that junk bond life. And if you're buying bonds, you should be buying government bonds, municipal bonds, or corporate bonds. I'm gonna just go out on a limb and say that. And then the last type of bond are international bonds, right? And so these are bonds that are issued by foreign governments or corporations. And so the wealthy invest in these from a diversification beyond the U.S. exposure to different economies and currency. The risks here are their currency risks, right? So if foreign currency weakens, then your return drops. There's also political risks, right? We don't live there, so we don't know what's going on in these governments, right? So you just want to be thoughtful to make sure you invest in international bonds from a stable government, right? So you would invest in Japan over Ukraine, things like that. Then there are savings bonds, are issued by the U.S. government directly to individuals. There are a couple of types here. There's the Series I bond, where the interest rate adjusts with inflation. It's great for protecting against rising prices. There's also the Series EE bond, which has a fixed interest rate and is guaranteed to double in value if held for 20 years. And so these matter because they have lower minimums, right? You can buy for as low as $25. They're safe, they're backed by the U.S. government, and they're really good for conservative savers or gifting to children. That's cute, right? It's cute. You've heard of that. You've heard of these things. It's funny. It was a popular thing to do at one point, but you rarely hear about people gifting these to children today. I'm thinking about, there's a lyric that Jay-Z talks about when his mom bought him a bond and he thought it was just the sweetest thing. And it is really sweet. It's really thoughtful. But my daughter drinks matcha once a week, and that's partially my fault. So she might not appreciate my purchase of a bond for her. Anywho. Okay. So there are two ways for you to make money on bonds. One is through your coupon rate. So that's that predictable income that we talk about getting paid every 6 months. The other one, though, is appreciation. If you sell your bond before it matures and you sell it for more than what you paid for it on the secondary market, then you can get money in that regard as well. And so the price the bond can go up or down based on interest rates and credit ratings as well as market conditions. So we talked about that. Like if you have a $10,000 bond, we talked about if you sell it for $7,000, but say that you got that 5% coupon, the interest rates go down to 3%, then your bond is more attractive, right? And you could sell it potentially for more than the $10,000 you bought it for. And so that's a way for you to make money. So we'll talk a little bit about the interest rate relationship and how that impacts bond prices next week. But this week, let's talk about the wealthy never ignore bonds and their value because they're really great for capital preservation in unstable times, right? So bonds are stable and you know what you're getting, right? They don't crash like stocks can, even though they can, but they don't normally, right? So these things, bonds generally stay stable. And then the wealthy love the predictable income, right? They get paid every 6 months and they know that and they could factor that into whatever type of financial situation they need. It's also great for portfolio diversification. Bonds don't move in sync with stocks normally. So when stocks crash, bonds generally hold steady or even go up, especially government bonds. And so that's how that classic 60% stocks, 40% bonds portfolio came to be. Now those ratios are different, but it's still the thought process behind them in terms of making sure you have a certain amount of stocks and bonds to buoy the volatility that happens in the stock market. That's still the same. They also like the lower volatility, right? Like bonds are stable and boring. And that's a good thing when you're talking about portfolio allocation. And then there are tax advantages, right? We talked about that. If you invest in municipal bonds, offer a tax-free interest. Treasury bonds are exempt from state and local taxes, right? So these tax advantages do matter if you are a high earner. Then obviously the ability to hedge against inflation, right? So if you invest in a treasury inflation protected security, that's a wonderful way to maintain your purchasing power or protect your purchasing power especially as we're in this economy that is suffering from significant inflationary pressures. You earn good money, real good money, and yet you're still not entirely sure how to manage it and invest it. You've listened to the podcast, you've attended the webinars, and you've already started investing. And somehow, with all of that, you're still second guessing and afraid that you won't be able to create that 7 or 8 figure wealthy life of your dreams. The Sovereign Collective was built just for you. A judgment-free and safe space specifically for high-earning Black women who are ready to stop pretending that they have it all together and actually start building generational wealth. Just 20 seats. 20. Learn more at joinsovereign.co. And remember, you are always wealthy. All right, so let's talk about some common myths associated with bonds. It's so funny. It's so true. This first one, myth 1, bonds are only for old people. It's not true, right? Bonds are for anyone who wants stability, income, and diversification, right? So even young investors should have some exposure to the bond market, even if you are very, very aggressive like I am. Myth 2, bonds don't make money. Also categorically false. Bonds have returned 5 to 7% annually over the long term, and that's not as high as stocks, but it's solid, predictable growth with way less risk. Myth 3, bonds are risk-free. Lies. That's not true. Government bonds are safe. Some would say very safe, but corporate bonds can default. And we'll talk about in the coming weeks about the pressure that is happening, or at least people saying that Trump is trying to devalue the dollar and what impact that could have on bonds, and or what's happening potentially with BRICS. And if the US dollar is no longer foundational to the global economy, like what that can do. So it's not completely risk-free, but it's probably the safest or one of the safest investments you can make. Another myth is you can't lose money in the bond market. And if you sell a bond before the maturity when interest rates have risen, you can in fact lose money. But if you hold until maturity, you should get your principal back, assuming there's no default and other things like that. So let's talk about, lastly, why you should care. You should care about bonds today because interest rates have been very volatile, and the Federal Reserve has been raising and lowering interest rates aggressively over the past 2 years, and this impacts bond prices and yields. Also, number two, stocks are expensive. It's like crazy. Stock valuations are at an all-time high, and a correction may be coming. So bonds provide a safe space for you to shelter your wealth while the stock market is going through its level of volatility that it's having. And inflation is still a concern, right? And so investing in TIPS and I bonds will protect you against inflation. And if prices keep rising, bonds ensure that your money doesn't lose its purchasing power. And then you need the diversification, right? If you're 100% in stocks, you're taking on a lot of risk that you might not be intentionally doing. And so bonds provide a little bit of stability there. And then lastly, retirees need income streams. And so if you're approaching retirement or already retired, bonds provide a predictable income that you need without the volatility of stocks. So the wealthy aren't waiting for a crash in the stock market to start caring about bonds. They always have had bond exposure as part of a balanced portfolio. And so what I want you to think about today is that bonds are loans. You lend money and they pay you, the borrower pays you interest, and you get your money back at maturity. It's not sexy. It might not even be exciting, but it's essential. And the bond market is the foundation of the global financial economy, and governments and corporations depend on it. And why not leverage it to adequately diversify your portfolio? So next week, we're going to dive into how interest rates and geopolitics affect bond prices. And then in the weeks coming up, we're going to talk about what happens if the dollar gets devalued and how you should be thinking about adding bonds into your portfolio allocation mix. And so I know it didn't seem sexy, but it wasn't that hard. It wasn't that crazy. I know it wasn't that crazy. But that is it for today's episode. If you found this episode helpful, please share it with a friend. And don't forget to like, subscribe, and follow wherever you get your podcasts. We are on Apple, Spotify, and YouTube, and we will see you next week. Bye.